Welcome to The Explainer. Today, we're diving headfirst into a really jarring financial paradox surrounding Norway's energy giant, Equinor, ticker symbol EQNR. We're going to put it through the ultimate value gauntlet. See, on one hand, you've got massive dividends and record earnings. But on the other, some truly terrifying underlying metrics. It's this fascinating tug of war, and we are going to break the whole thing down for you. So right off the bat, on the surface, Equinor just looks absolutely unstoppable. We are talking about a company posting a monster 107.8% earnings per share growth year over year. Pair that kind of growth with a super juicy 7.4% dividend yield, and man, for a lot of dividend hunters out there, this looks like the absolute holy grail. I mean, it sounds like the ultimate energy stock, right? But here's where things get really weird. Despite that massive growth and a stock price sitting near a 52-week high, their return on invested capital is at an absolutely abysmal 0.1%. Yeah, 0.1%. It's this glaring, massive anomaly that should honestly make any serious investor just stop dead in their tracks. To solve this mystery, we're going to look at the ultimate energy paradox, expose the hidden red flags, weigh the compelling green flags, put the stock through a legendary guru face-off, and finally settle the moat debate with our final verdict. First up, Section 1, the ultimate energy paradox, where we look at these record highs versus the underlying flaws. On paper, Equinor, which is Norway's state-controlled energy giant, is just executing at the highest possible level. Look at their Q2 2026 performance. They brought in a massive $35.2 billion in revenue, which is up 40%. Operating profits surged 76% to $11.5 billion, and total production, it hit record highs of 2.17 million barrels per day, a 3% bump. So honestly, it's really no wonder the stock has shot up around 63% over the past year, hovering right near its 52-week high. Outwardly, they are executing flawlessly. But let's move into Section 2, the hidden red flags. We need to expose the cracks in this foundation. We have got to start with the elephant in the room here, that ROIC disaster. You know, Warren Buffett famously said that the single best proxy for moat strength is an ROIC consistently above 15%. Well, Equinor's 0.1% ROIC is a staggering 150 times lower than Buffett's threshold. This exposes a gross margin of just 0.3%. So what does that actually mean in plain English? It proves they have virtually zero pricing power. They are price takers completely, not price makers. And in the quality investing world, no pricing power means absolutely no moat. And the governance structure really adds to the risk here. The Norwegian government owns a whopping 67% of the company. From an objective standpoint, that means political decisions can very easily override commercial logic. Things like dividend policy or capital allocation, those are subject to government goals, not necessarily maximizing shareholder returns. And to top it all off, insider ownership is sitting at absolute zero. Literally zero. There is no executive skin in the game. To make matters even worse, analysts are projecting earnings to drop by a staggering 24% next year. They see EPS falling from $4.93 in 2026 all the way down to $3.75 in 2027. When earnings are expected to just fall off a cliff like that, their current valuation, which is already sitting well above its historical medians, suddenly starts looking extremely expensive. And, you know, the warning signs just keep building. The analyst consensus is currently a hold with an average price target of $37.30. That's actually 5.5% below current trading levels. Guru Focus calculates a value of $30.64, rating it as modestly overvalued alongside 7 distinct warning signals. Plus, Equinor is pouring massive amounts of capital into expensive transitions into lower margin wind and carbon capture. Now, those moves might be environmentally friendly, but financially, they are going to weigh heavily on future returns for years to come. Now, let's switch gears to Section 3, the compelling green flags and why buyers are still hooked. Because, to be fair, we have to look at the whole picture. The crucial point here is that Equinor is a genuine, undeniable cash machine. They have one of the most conservative, bulletproof balance sheets in the entire global energy sector. We're talking a debt-to-equity ratio of just 0.73 and a net debt-to-EBITDA ratio that's incredibly low, between 0.66 and 0.78 times. Their interest coverage is over 26 times, and they are sitting on over $20 billion in total cash. But my absolute favorite metric here, their free cash flow conversion is 1.19x. That means for every single dollar of profit on the books, it actually becomes $1.19 in hard cash. They also boast some massive structural advantages. If you're looking for a defensive play, this is it. They have a completely insulated geopolitical footprint with zero Middle East assets. That means incredibly stable operations. Plus, they benefit from a huge currency advantage. They pay their costs in the weak Norwegian krone, but they sell their oil in strong US dollars. Add in a negative beta ranging from negative 0.01 to negative 0.74, which really protects against market downturns, and you get a massive total shareholder yield of 9.3% when you factor in their $3 billion buyback program. It's pretty compelling stuff. So let's put this to the test in Section 4, the ultimate guru face-off, where Graham, Lynch, and Buffett decide. First step to the plate is the father of value investing himself, Benjamin Graham. He gives the stock a mixed C grade, 50 out of 100. Why? Well, because the valuation multiples are just way too high right now to offer any real margin of safety. The PE of 16.3 and the price to book of 2.1 both fail his strict limits, and that 6.1% earnings yield, it doesn't quite clear his 7% hurdle. So for Graham, the price is just a bit too rich. Next up is Peter Lynch, the legendary growth at a reasonable price investor, and he hits Equinor with a brutal F grade, just 16 out of 100. For Lynch, the formula completely falls apart here. When future earnings growth is deeply negative, the PEG ratio just breaks entirely. Combined with sluggish revenue growth, Lynch would see this as a classic case of growth too low, price too high, and he'd just turn and run away. Finally, Warren Buffett. He passes on it completely. Because look, while he might absolutely love that fortress balance sheet and a heavy free cash flow, an ROIC of 0.1% is a total deal breaker. It means absolutely zero pricing power in a pure commodity business. His framework demands a gross margin over 40%. Equinor is sitting at just 0.3%. It completely, utterly fails the quality test. Which brings us to our final section, Section 5, the moat debate and final verdict, resolving the Equinor mystery. There's just a massive disconnect here between the qualitative narrative and the quantitative reality. Guru Focus gives them a narrow moat because Equinor has these highly privileged, low-cost assets in the Norwegian continental shelf, which are backed by huge regulatory barriers. But the numbers, the quantitative reality, destroys that narrative. That 0.1% ROIC and 0.3% gross margin tell the real story. Equinor definitely has a geographic and cost moat over Norway, but because oil is a global commodity, they have absolutely no pricing moat whatsoever. Ultimately, what this explainer reveals is that Equinor is just a fascinating contradiction. It is highly profitable today, it boasts record production, and has an incredible balance sheet. But that terrible ROIC, the structural lack of pricing power, and the state-controlled ownership, that all makes it simply too risky for quality-focused investors at its current near-high prices. Honestly, it's a great cash machine, but it is a terrible Buffett stock. If you are tracking this company, here's your timeline. You're going to want to keep a very close eye on late October 2026 for their Q3 earnings. That release is going to be the first major indicator to show us if that devastating 24% earnings drop projected for 2027 is actually materializing, or if their execution can somehow continue to just defy gravity. And that leaves us with one final critical question for you to think about. Let me know in the comments, does a fortress balance sheet, a perfect geographical footprint, and a 7.4% yield make up for a 0.1% ROIC and negative future growth? Or is this just the ultimate value trap? Thanks for walking through this explainer with me today. Remember to always do your own homework, stay sharp, and keep learning. I'll see you in the next one.